Incremental earnings. In previous modules, we looked at incremental revenue and costs that occur each year of a project, and we've looked at depreciation. The only other cash flow that occurs on a yearly basis is the tax associated with the incremental revenue and costs, and that's the focus of this module. Although it's possible to calculate the tax as a separate item of cash flow, the approach that we will use is to calculate earnings on a yearly basis. In the next module, we look at how we convert from earnings to cash flows. The first thing we need to do is to calculate incremental earnings before interest and taxes, or EBIT. And for most of the remaining modules, the examples will be based around Project Alpha. It's a 4-year project with a $1,000 outlay. It'll generate incremental revenue of $500 and incremental costs of $120 per year. Broadly speaking, there are 3 items that contribute to earnings or profit for the year: incremental revenue and incremental costs and depreciation. The incremental revenue is $500 per year for 4 years. Incremental costs are negative $120 because they are cash outflows. We are told that we are to use straight line depreciation. So the amount of depreciation is the initial outlay of $1,000 divided by the life of the project, or 4 years. That gives us annual depreciation of $250. As has already been emphasized, this is not a cash flow, but this is not a table of cash flows. This is a table of revenue and expenses in order to calculate earnings or profit. So to calculate incremental earnings before interest and taxes, we just have to sum these amounts, and we get $130 per year. In order to calculate total earnings, we need to adjust the EBIT for tax. If the tax rate is 30% and the incremental EBIT per year is $130, then the tax is equal to 30% of $130, or $39. We can now calculate incremental earnings by deducting tax from incremental EBIT, and we get incremental earnings of $91 per year. This structure is broadly similar to the profit and loss statement. Revenue minus expenses gives us EBIT, and then we subtract tax to give us incremental earnings. The key difference between the format of this table and the profit and loss statement is that we are not deducting interest to calculate earnings. As was emphasized in a previous module, financing cost, such as interest, is excluded from the cash flows in an NPV analysis. In the next module, we look at how we convert earnings to cash flow.